Amnish Aggarwal also joins us on the show to talk to us about the fundamentals right now. Overall, for the market, if you're looking at the sector-wise breakup today, it's PSU banks which are on the back foot. But having said that, railway stocks are doing quite well. Defense has managed to come back. In fact, other industrials and public sector entities have been doing well. Amnish, does that make you believe that perhaps the dip that we saw in the public sector entities, whether defense, whether railways and all of that, it's behind us and now the buying would resume?
Okay, hi. See, one can't put all the PSUs in one basket per se, because what has happened is when it comes to railways, when it comes to defense and some of the other industries which are related to capital goods, engineering, EPC, construction, etc. So what is happening is in the first 6 months of this year, there were no order flows which came in 1Q. In 2Q, it picked up, but now we are in the last 4 months of the year, and the government had significantly, you can say, the order inflows and spending has been very, very limited in the first 6 months of the year. Now, as we move towards the, you can say, close of the year, I think you will see more and more order announcements which will happen across these segments. And I think that is what is reflecting in the strong outperformance of many of these sectors. So as the order announcements are likely to continue, say for next couple of months, I think the interest levels will continue to be high. But having said that, I think one needs to be very cognizant of the fact that any sharp run up in the stock prices and any run up which is beyond the fundamentals, I think one should be very, very particular about that, because as we have seen in the past that during market correction, the stock can even show negative returns.
Coming in on this entire PSU basket of stocks, Amnish, hold that thought while I'm going to reconnect with Kunal and Nuresh and get the BTST ideas out of the way. Nuresh, coming to you first, what are your BTST picks for today?
So first would be a buy in Apollo Hospitals. The stock is closer to a new all-time high. Stop loss at 7,300, target price of 7,400. Second is a buy in Tata Communications. The stock is crossing the last 20-30 days high. Stop loss at 1810, target price of 1880.
Hospitals and Tata Com looking good to Nuresh on the BTST basis. Kunal, what about you?
So there will be one Bajaj Finance, for a short-term target of 7,400, especially after today's breakout of its 200 moving average. Stop loss to be kept at 7,000. And trend is something which is started to come back into a trending mode after almost 3 or 4 days of consistent price correction. So looks attractive for a BTST target of 7,200. Stop loss at 6,850.
Okay, so those are the BTSC trades coming in from our technical experts. In the meantime, take a look at Kalpataru Power inching higher right now. Max Healthcare is doing quite well. KIMS, or that Krishna Institute, is also doing quite well. In the last few minutes, it's managed to perk up. But on the losing side, what's coming under pressure? Well, PNC Infratech is giving up slightly. Torrent Power, ICICI Lombard, these are some of the other names. But Amnish, if I had to get your take regarding pharma and some of the CDMO companies, because they were pinning their hopes on the Biosecure Act, that seems to have got delayed, if not off the shelf completely. What happens to the fortune of some of these CDMO players then?
You see, now US, we are going to have a new, you can say, president in place from 20th of January. Now, I think if the bill doesn't get through during the current government, then I think what form, shape it will come or it will not come, that becomes uncertain. And due to this very particular reason, all the CDMO and all the many of these API companies, so they have been on the receiving end. So I believe that now the kind of leg up which had come in many of these stocks, that is the reason for that no longer exists. I think they might, you can say, correct to a certain level, and then I think it depends on what happens on that front in the medium term. So to that extent, I think there could be some uncertainty, and for the time being, I think, again, that sort of a bounce back doesn't look likely.
Okay, so that's the take coming in on the entire pharma space. But let's also go across and listen into what Vishal Manchanda had to say about this entire upheaval or the impact from the exclusion of this act from the US defense bill and how that's going to pan out for our companies, our pharma companies back home.
Multiples, I would say, are a bit extended and it may not, so they partially built in the upside that was expected to come from the Biosecure Act. So I think that with this uncertainty, we should expect the multiples to contract a bit from where they have been. This sector broadly is witnessing pricing pressure. and it has been so for the last few years. And I don't think this is going to improve. The pricing challenge would remain. Volumes is the only way to grow. And these companies, but we are seeing intense competition. The competition is getting more intensified here. So I think it can still grow, say high single digit, low double digit, but we shouldn't expect any higher number here on the diagnostic growth front. GLP-1 is one area where Indian companies are waiting for contract manufacturing opportunities. So I think Divi's, Suven, Piramal, and Newland also is one more name that I would like to add to the list that is expected to do well in this space.
So that's a take on pharma, but the banking index is coming under pressure right now. ICICI Bank is down, HDFC Bank is putting some pressure, SBI too is down in the trading session, has been for most part. In fact, PSU banks have been weak, but it's ICICI Bank and HDFC Bank which are also getting a bit undone, and that's putting pressure on the frontline index as far as Nifty Bank is concerned. But Amnish, if I had to ask you about the disruption which is underway when it comes to the FMCG sector, just now we are getting the update from Swiggy that they're likely to launch One Black, which is their, premium membership of sorts. Yesterday we heard about Amazon getting into the quick commerce category. 15-minute delivery is what they're targeting. What happens to the incumbents, the likes of Avenue Supermarts?
You see, already we are having 4 players. That is your Swiggy Instamart is there, Blinkit is there, your Zepto is there, and maybe Now is there. Now Flipkart Minutes and Amazon also come into the frame. Now it depends that how much of incremental players entry will give incremental volumes or kick to the consumer to buy more. Because whether these are 2 players or whether these are 4 players, unless and until you differentiate the product, you offer something new to the customer which other platforms are not doing, then you will not be able to generate volumes. That is one. Secondly, otherwise, what is going to happen that all these 4 players or 6 players now, they are going to slug out very badly in order to garner the eyeballs, in order to get the consumer orders. So it might result in, you can say, more discounting, more offers, like for example, three-month membership, 6-month membership. And I think the entire industry dynamics is going to change on that side. Now, when it comes to DMart in particular, I think, you see, if you have to look at, say, the mix of the company. For example, DMart is, say, roughly around 23% or comes from, say, your apparel and general merchandise. One part is your FMCG. So not the entire, these your quick commerce platforms, they won't be able to capture the entire monthly requirement of the consumers. So far, if you look at the average ticket size, it is roughly around 500, 600 rupees. When it comes to DMart, the average ticket size is more than 1,400 rupees. So the consumer affinity for both the segments is there. They will continue to coexist. But having said that, the incremental hit on DMart will depend upon how much of incremental orders or how much of AOV these guys can push beyond apparel, beyond some of the durable segments, electronics, etc., which they are going to, you can say, enter. So if they are able to move that AOV, if they are able to garner more sales volume, which might not be that easy, because say if you are, you can say, giving higher value orders for your grocery, so that is, I think, yet to be fully tested with some of these your quick commerce companies. So I think definitely the competition is going to increase, and its impact can be a little bit on Avenue Supermart also. But I think particularly 3Q numbers will be key to watch out for, because first time it was, you can say, called out for in the 2Q numbers. So let us see what happens in the 3Q as far as the Avenue Supermart is concerned.
So, looks like Avenue Supermarts actually has its work cut out for itself and needs to pull up their socks now, because lots to do in terms of the rising competition now that you have more players heating up the quick commerce space. But Kunal, talking about competition, I want to get your view on the charts of Swiggy, because, other than everything that's been happening on the fundamental side today, the equity lock-in also has ended for Swiggy. Approximately 3% equity is out in the open market now. Tell us what sense are you making of this stock on the charts, because every time in the last couple
couple of trading sessions, we've seen the stock move. It's always either been like, it's either 4% higher, today it's 3% lower. It's never been a 0.5% move. It's not something that moves very lightly. So tell us, what's the take coming in on the charts, and what are the levels that you are also spotting for Swiggy?
Yeah, that generally happens when there is a lot of expectations, built up into the stock, and of course, that leads to trading volume, trading activity, or much heightened trading activity into the stock price. The chart history for Swiggy is a lot more limited, but then whatever the price history suggests over the last 3 weeks of the data, it indicates that from those 400 levels, the stock had moved into a very calibrated move towards the 550, 560 mark, which I think it tested couple of trading sessions back. Today could be a day where the stock is taking a bit of a gap down, and then from those gap down levels, the stock has maintained the downward bias, even though it's been trading into a range. However, I think it looks like that the stock is still into a firm footing on the upside. We've not seen any major selling on the back of higher volumes for Swiggy post the listing. I think that's one of the major reasons why I would believe that this trend should continue. So my belief is that hopefully in the next 1 or 2 days, the selling should be absorbed and the stock may come back into retesting its previous swing high.
Yeah, and then there is that trigger of the inflows which are expected on account of some rebalancing as well. So that should play out next week. But public sector banks, Naresh, have been under pressure, whether it's an Indian bank, whether it's a PNB, SBI itself, Canara, Bank of India, all of those names. Anything that you would want to buy at lower levels? Naresh, the question is
Is
for
where
you.
Yeah. So looking at the smaller names, Bank of India looks interesting. The stock has corrected from 155 all the way down to 100, and now making a comeback. So this name looks interesting. Similarly, a Punjab National Bank saw a very sharp correction from 140 odd levels all the way down to 95, and now starting to make a base. So the smaller PSU banks look interesting because they're still down 30% from the top, and a base formation is already done on the downside. So I would expect a slow and steady recovery across the whole small cap PSU banking space. On the other hand, the largest one, SBI, continues to sustain above the 850, 860 breakout. All-time highs are around 900 odd levels, which has been tested a couple of times. Once that crosses, it gets into a momentum. So for now, the risk reward is well placed for the smaller PSU banks.
Point taken. Amnish, what about the IT pack? I mean, Nifty IT has been hitting record highs in an otherwise weak market. Today, it's scaled a fresh high. Which stocks would you recommend? Because till last year, the idea was that being niche names, being those mid caps which are outperforming, but then came the overhang of the auto slowdown or auto spend slowdown in Europe. Now, what would you recommend? Stay with the large caps which are better equipped to deal with the Gen AI disruption, or still stay with the niche names which are likely to deliver at least a double-digit growth?
You see, there is a marked slowdown which is there in Europe, whether these are ER&D companies or auto companies. So they are feeling, say, some heat over there, and that is reflected in the numbers of whether you look at the likes of, say, even your KPIT is there, Tata Elxsi is there, even LTTS didn't have that great a number. But broadly, people are of the view that the spending in the US markets or in the some of the developed markets that should pick up. And some of these large players, they seem to be better placed to, you can say, navigate this. So that is why you see in the long term, some of these ER&D companies or mid caps are also good. But I think somehow, if you look at, say, in terms of multiples also, if you look at, say, 2 weeks back, TCS was actually trading at a discount to where some of these other large caps are also there. So I think at the current juncture, for example, if you are looking at growth and LTI Mindtree looks good, so I think it will be more like an entire pack moving forward, because some of these large cap stocks, for example, you look at, say, Infi or TCS. So are they on very expensive valuations, or whether they were there 2 years back? The answer is no. But are they very cheap at, say, 15, 16, 18 times? That also doesn't seem to be the case. So I think a lot depends on how the growth momentum pans out. But I think there's a lot of expectations which are built into that what happens more in the developed markets post, say, once Trump assumes the chair next month. So I think that is getting reflected, and also the fact that the domestic growth scenario looks quite mixed as of now in many of these sectors. So IT looks to be more safer and more defensive in comparison to some of the other segments.
So that's the view coming in on IT. But Kunal, we've seen a brokerage note coming in the morning that has a sell rating on Wipro with a target price of 290 rupees per share. Do you concur with that view coming in? Does Wipro deserve this sell call on the charts? And is the 290 level also the level that you are spotting for Wipro, or is there something else that you are penciling in for this chart at least?
I would be bullish on Wipro. In fact, from even from current levels. In fact, over the last few weeks, I've been highlighting this as a potential swing breakout trade. The stock has done reasonably well in the last 2-3 weeks, moved up from 280-85 levels to now 310, where it's trading right now. And that too, I think, at a point where, if I'm not wrong, this is the 6th or the 7th consecutive month of price uptrend for Wipro, and it's been moving in a very slow, gradual, calibrated manner in terms of closing basis. Yeah, within the month, the stock sees a lot of volatility. But then till the end of the month, if the stock closes on a positive note, that generally is an indication that the carry forward momentum is on the bullish side for stock like Wipro. So my sense is that the stock should continue to move up higher. My expectation is that the stock should move now towards the range of at least 330, 335 over the very near term.
Okay, point taken. So that's a view coming in as far as some of these IT names are concerned. My colleague Asta just got the opportunity to chat with the Britannia Industries CEO. So some of the important headlines coming in there suggest that they're going to go aggressive and absorb the prices by 3% to avoid the pressure on consumers. So they're not looking at price, passing on the price pressures to the consumer directly might hurt the margins in the interim, but they're willing to do that because, of course, consumption has taken a hit. Larger packs will witness higher prices. They're expecting that they're open to partnerships for innovations, and they're doing a lot in order to reach out to the consumers to make sure that premiumization trends picks up. But for now, given the fact that prices of flour, cocoa, palm oil, they have all risen, they are likely to perhaps take the hit on their margins and not completely pass it on to the consumers. And they're taking strong steps to ensure that the rural demand is met, and they're, of course, investing in the digital side of the business. So that's the interesting commentary coming in, and we'll try and kind of play out a soundbite for that, of that interaction to you very, very shortly. But that seems to be the problem, right, Amnish? On one hand, consumption is not picking up, as in the demand is not picking up. And on the other hand, the prices of the raw materials continue to be fairly volatile. Do you think 2025 will be marked by a margin compression for a lot of these FMCG companies, and not only the volume pressure that we saw in 2024?
Not something which was unexpected. Because if you look at, say, FY24 for the entire consumer pack, while the volumes were not good, we had lifetime high margins for, I would say, 80% of the companies. And this year, the expectation was at the beginning of the year that while the volumes will come back, the margins are not going to increase. And in some of these, I would say, input costs also, it is not that the inflation has come in a day. For example, you look at palm oil, the duty increase happened in the month of September. But the international prices, they have been slowly inching up from the last 6 months. Wheat prices have been inching up since June or July. Now, as far as your demand scenario is concerned, I think it is not only to do with the input cost, it is to do with the broader inflation in the economy. If you look at last month numbers, the food inflation was running at 10 to 11%. Now, once the food inflation is high, then the incremental demand generation in terms of volumes, that becomes very tough. And secondly, in this kind of an environment where the demand scenario is certain, the companies would obviously be very hesitant to pass on the input cost inflation. So I think if you look at, say, FY25, in FY25 now, the balance few months, I think the focus for most of the companies will be somehow to keep the volume growth intact or to sustain the volumes, whatever they are having, and slowly and steadily pass on the cost increase to the consumers in a very calibrated manner, so that in the next few months, if the inflation also softens a little bit on one hand, and then the consumer overall situation stabilizes, then they should be in a better position at least in the next year. But for the next couple of months, I think for majority of companies, we are not going to get any positive commentary or any positive surprises.
Point taken, but it's the man of the hour which is on the screen, Amnish, and that's Sanjay Malhotra, of course, the new RBI governor taking charge. He's getting decked up to speak at the first press conference as the RBI Governor. He, of course, is going to be the 26th RBI Governor. He has, of course, a long history to go by with respect to the, administrative service that he has done. He has, of course, the IIT Kanpur engineering degree to back him up. He has been studying public policy at Princeton. So he has, of course, enough backing to go by it, and the entire career wherein he's played part in the power sector, finance sector, as well as taxation, information technology and mining. He has played roles across various streams. He has, of course, a 33-year experience. He's been a career bureaucrat. We have seen that's been something that the government has been, favoring as far as the RBI Governor position is concerned.
If you like this video, then like, share and subscribe to ET Now.